According to the International Air Transport Association, the global airline industry will continue to perform poorly this year in light of the rising cost of fuel and weak economies. IATA forecasts that airlines will continue to see the declines in revenues, generating profits of only $3.5 billion this year, a drop from the estimated $6.9 billion in 2011. Regional Manager of Emirates Fouad Caunhye spoke to Uche Okoronkwo about the future of the industry and plans to manage this bleak outlook.
We might end up having a worse than expected impact into 2012. Having said that, if there is anything as a silver lining, you know, the reading we can make is that there are some lanes that are open for a positive transactioning. I'm talking of China, for instance, where we have seen, you know, that the overall industry has recorded seat factor levels of above 80%, you know, during the past year. In the Americas, where the seat factors have been encouragingly industry-wide above 83% during the past year. Latin American economies, you know, have also produced fairly decent levels of, you know, of revenue based on a 10%, you know, increase in demand. We are positively expectant of the future, but we are also cautious about what the future entails. And into our own region, into our own Africa region, you know, we have seen encouraging signs, you know, of demand growth over the last year. Maybe not in the same levels as are expected in other regions. To put things simply, you know, like Europe grew by about 5% average demand last year. It was about a similar level for Africa into the last year. And but then, you know, at the same time, capacity has also, you know, not followed up into the African region. So we think that it's going to be a challenging year, but we think that we are sufficiently equipped to deal with the challenges of the coming year.
The International Air Transport Association also predicts a slowdown in global airline passenger growth from 6% in 2011 to 4% in 2012. Now, what impact do you think this is going to have on competition amongst carriers in the sector? What are airlines going to do to sell more tickets?
As you know, the nodes of demand into Africa are very singularly based on a few hubs. Nairobi is one of them, Addis Ababa, Lagos, for instance, and then, you know, 1 or 2 points in North Africa. But as you know, North Africa, you know, has, as far as the airline industry is concerned, you know, has literally, you know, been, you know, under a bit of a gloom, you know, recently. So those nodes connect, you know, into deeper regions, and then this is, you know, you have a convergence of smaller airlines supplying into bigger airlines, and then bigger airlines themselves having, you know, smaller capacity gauges, you know, to tap into the hinterland, you know, the African regional points. It's been a model that has worked for a number of years. Will it be a model that will continue working into the future? This is something that is under a big question mark, because as you have conduits and you have sub-deliveries, you're talking of a cost model that increases. The more additions or the more links you put, you know, into, for instance, a flight into Nairobi or Addis or Lagos, then connecting into Gabon, then connecting into Congo, you know, connecting into the Great Lakes region, means more costs. As you have rightly mentioned, demand may likely be falling, and with demand falling, you have an overcapacity in those markets, which would mean that everyone will end up competing on price.
Do you think that the recovery of the industry is dependent on fuel costs and capacity? What else do you think that the region will need in order for carriers to post profits and get back in shape?
I think that the $3.5 billion, you know, expectation, you know, of profitability into 2012 itself is based, you know, on aspects of, you know, the world economy remaining, you know, ceteris paribus, you know. So we and this itself, is based on a drawdown from the profit expectation of 2011, which is about 6.8 or 6.9 billion. So. How do we look at the future, and how do we assess the future? Based on those elements of profitability, you would remember, that the global industry is working on very, very slim margins. We're talking of a profit element based on around $680 billion total turnover, which is itself based on a 1.2% margin. If we are looking at 3.5 billion in 2012, this is itself based on a margin that is reduced less than 1%, around 0.6 or 7%. So the margins of maneuver get very, very slim, profit-wise. At the same time, there is also a very significant development of channels, which means that there are new segments, being hooked on the travel market. Talking of money, talking of profits, and talking of costs, removes one important and probably the most important element from the equation, and that important element is the passenger. Having said that, new segments mean more pressure on development of new accesses to tap into those segments, more marketing values, more competition, and even more reduced profit margins. So the way forward is to relook very critically at our cost outlays.